So midterms are here, and of course, that's been making everyone anxious and nervous for what's about to happen, especially stock investors. They are worried about what's gonna happen to their money.
And it's gone.
So in today's video, I want to try to make sense of everything that's going on and to show you exactly what to watch out for and show you exactly what I'll be doing with my own money. So with that being said, this video took a really long time to make, so I would really appreciate the early thumbs up. So let's not waste any more time, let's get into it. Now, since the beginning of 2022, we have seen the market completely get destroyed, mainly due to the fact that there has been so much money pumped into the economy that the US is now seeing its worst inflation in 4 decades. The Fed is also raising interest rates, and that has scared the markets as well. Then there is the war in Ukraine, with disruptions of the commodity markets and the prospect of global recession starting in Russia and Europe. So these factors should explain why the market is down in a midterm year.
This year was crazy. It was very crazy. Yeah, so
Now you see, according to a recent study by the New York Times, the average gains from the Dow Jones for presidential terms from the 1900s to 2021 are these. In the first year, we have a 12.7% gain, midterm year is 3.1%, year 3 is 14.8%, and presidential year gains are 7.4%. Also, the S&P 500 shows similar results from 1948 all the way through 2021. In the first year, we have a 12.9% gain, midterm year is 6.2%, year 3 is 16.7%, and presidential year gains are 7.3%. And now here's where you need to start paying attention, because in our most recent 2018 midterm year, the stock market rallied quickly after the Democrats took back the House while Republicans maintained a majority in the Senate. The Dow Jones went up by over 250 points the day after the election, which totaled to a 1% increase, while the S&P 500 and Nasdaq also increased by over 1%, and this shows us that whether a party gains or maintains control of government is the most significant indicator of how well the market is going to perform. But here's what's interesting about the election and the markets. Presidents and Congress have 2 issues to deal with right now. They both need to govern the country, and they both need to get reelected so that they can pursue their own agenda. Now, both the second and fourth year of a presidential term are commonly more focused on politics and the coming election than on government, while the first and third tend to be more focused on the governance. And one political factor that arises every election year is cutting back on spending in order to balance the budget. You see, less government spending generally means less money in the economy and a weaker stock market. But no matter what else is going on in the nation and the world, these factors always tend to affect the stock market every single presidential term. So then what can we expect from the markets after midterms? Well, let's aggregate some data all the way back to 1954. Now here's the data for post-World War II midterm elections going all the way back to 1954. And on average, for the 16 time periods measured, the markets rise over 5% from the election day all the way to the end of the year, and rise 11% over the next 12 months after the election day. Here's another study that was done by Stephen McBride, who determined that after midterm election years since World War II, found that in all 18 midterms since 1946, stocks have increased an average of 17% in the year after a midterm. They also found that historically, the third year of a presidential term is the strongest year for stocks. So in our case, 2023 could be very bullish for stocks and the rest of the market.
Awesome.
Now, before I show you what I'll be doing with my money, I'm going to show you different data this time and also show you why we could see history not repeat itself this time. So every year and every year after the midterm election, the results tend to be very similar. Midterm rally evidence is very strong, and past results don't always guarantee future results. But my conviction remains very strong because of the almost perfect win rate here. And remember that you can't predict the future, but the data is very clear. Midterm election years tend to be very weak, but the following year is typically very strong. Now here's the S&P 500 performance during the election cycles since 1932. So the dark blue represents the average gain, and the lighter blue represents the median gain. And this is where we are right now. The midterm election year, or the second year of a presidential term, and then this is next year, year 3 of a presidential term. And what do you notice since the 1930s? Well, the midterm election year has typically been the worst year in the market for presidents, while the year 3, 2023, tends to be the best historically. And here's one last chart for the stock market, which I think you'll like to see. Here we can see the 6 best month period to invest and see how midterms fit into this period as well. This month of November has kicked off to what's known as the best 6 months of the year to invest. So the last 6 months were the worst, and the next 6 months from here have historically been the best. And the data does back that up, because from May to October, stretched out historically, is the worst 6-month period for equity investors, and November kicks off the best 6 months of the year for stocks, which tells investors that price returns for the S&P 500 from November this month all the way through April of next year have recorded the highest average price change of any 6-month period for the year. So this chart is showing 6-month periods since 1945 based on post-election years. Now I'm going to show you the other side of the equation and why 2022 and 2023 could be different. Because what if we don't get a post-election rally like we're all expecting? Well, it might be very well be for a few reasons. You see, so far in 2022, the S&P 500 has performed much worse than the typical midterm election year. And if you've checked your portfolio balance or other investment accounts recently, then you've likely felt the pain. The S&P 500 is down around 20% for the year, with some stocks down over 50%. And don't even get me started on cryptocurrency.
Oh, it went to zero! Yo!
But much of these losses have been attributed to inflation, which is near its highest level in 4 decades. And the Federal Reserve's response to the high prices, because to bring down inflation, the Fed has been raising its benchmark interest rate, and most recently by 75 basis points in November, its 4th consecutive rate of that size. And while increasing interest rates is a tool used to bring down prices, it can also weigh on the prices of stocks, bonds, and cryptocurrency. And even though the Fed has hinted at smaller rate hikes during the recent meeting, there is still no guarantee that they are going to pivot sooner than we would want them to. So at the end of the day, it's going to be all eyes on the Fed. So again, historically, trends don't often give us the future, but they can prepare us for them, like I have been, because in my opinion, one of the most undervalued sectors right now is the tech sector. I mean, they are really beat up. Some of them back to their lows from 5 years ago, such as Meta. And you already know that they're not gonna go anywhere. Everyone still uses Facebook and Instagram, and the metaverse is still very, very early. Now, Google is also down 40%, and I mean, we are still using Google. You're watching this video all thanks to YouTube and Google. So long term, those companies are not gonna go anywhere, and in my opinion, they are bargains. And this is where the real transfer of wealth will happen, buying where there is blood in the streets.
We will have a lot of panic, more panic, and you'll have that. And as the saying goes, the time to buy is when there's blood in the streets, right? And to know when there's value, and those are the calculations one has to do.
Not only that, but big companies are also starting or planning to do stock buybacks. And this is extremely bullish for the company's stock, because a share buyback program consists of a company buying its own shares at the market price. And it's generally a sign that the company believes its stock is undervalued, and it's a way to boost the stock price. So if you believe that tech will come back, well, there's a lot of money to be made here. And one of my favorite plays here too is Tesla, who are also planning on doing a stock buyback sometime in 2023. And just remember that going back to the 1930s, in the last 87 years, if you missed out on the top 10 trading days in the stock market, the S&P 500, your money would return a 97%, which is not that bad, but when you compare it to 15,000%, it's really bad. And all you had to do was leave your money in the stock market. So that's just something to consider if you were wondering if you should pull out of the stock market and just wait on the sidelines. But if you want to be a real risk taker, which is something that I've been working on this year, then I think the price of Bitcoin and Ethereum is definitely going to go up in value after the election. And that's because we could potentially see the Fed not be as aggressive with the rate hikes. Going towards 2023, we might start to see smaller increases next year as well, with a potential pivot sometime in 2023. So it's going to be a very interesting week for the stock market, and whatever you do not forget to grab your free stocks with Webull, grab your second free stock with Robinhood, and if you want to be a risk taker like I am, then be sure to grab your free crypto with Coinbase or BlockFi. All the links are down in the description below. Thank you guys so much for watching. Until next time.